Hi, welcome to sixth video of this series, which is security lending or also known as stock loan. In this video, we will cover what is security lending or stock loan, basically what is stock loan and collateral, which is the major part of this business, why stock loan is necessary or why securities are taken on loan instead of buying them, then how to calculate collateral, then the difference between bilateral and triparty collateral, and how mark to market is calculated and what is its impact. Thank you. Now, what is security lending? When clients or firms buy shares for long-term investment, those shares just lie in their account doing nothing. So the only earning those shares have is the dividend, annual dividend, if the companies declare that. To generate income from such shares, those shares can be given on loan. This kind of loan is called stock loan or security lending. The shares or bonds lying idle in clients' accounts or proprietary accounts are used to generate revenue by lending those shares or bonds to other parties who are in need of same. And a fee is charged. This fee will become extra income on those shares and bonds which would have not generated anything else apart from dividend if they were just lying idle in that account. To safeguard lender in case borrower defaults, cash or some other securities are given by borrowers to lenders at the beginning of the loan. These cash or securities are called collateral. As seen in the diagram, lender has excess of securities X while borrower is short of same securities. Lender gives X securities as a loan to the borrower, and borrower will have to provide collateral to the lender, which can be cash or securities. Now coming to why take securities on loan. When someone does a short selling, that short seller can cover his short in two ways. First one is either they can buy the shares, or second option is they can take the shares on loan. Now the basic logic why a short seller will go for a stock loan out of the two options available is that a stock loan trade will be cost effective, as we will see down, and also the short seller has an analysis which says that prices of shares being taken on loan are going to go down in near future. Now to compare the two options and find out the best possible, let's assume that a short seller is short for security X for a quantity of 30,000 shares, which is currently priced at $100. The stock loan cost will involve assuming 10 basis points is the fee being charged, and those 30,000 shares are taken on loan for 15 days. The cost of borrowing stock will be nearly $370 for 15 days. Also, the additional cost will be the margin or haircut on collateral. While looking at the bought shares cost, it will be directly 30,000 multiplied by current market price, which will become $3 million. As seen in above example, the borrowing cost will be cost effective than purchasing the stock. For purchasing, the short seller will need $3 million at the same moment, while for borrowing the same amount of shares, they just need to pay $370, that also at a later date. Also, borrower will return shares taken on loan by buying them at a lower price when prices go down in future, as expected by that short seller. So now the loan value of party B will be calculated as price of security X multiply quantity of security X plus price of security Y multiply quantity of security Y minus price of security Z multiply quantity of security Z. Let's assume that this value becomes 100, then the loan value of party B is $100. In case party B wants to give cash as collateral, then a haircut is applied on the loan value. The logic behind applying a haircut is that when the collateral is provided as cash, party A will be able to utilize that cash very easily. Thus, they can generate a good return out of that cash collateral. Assuming that a haircut of 5% is applied, then the cash collateral value will be 95% of the loan amount for party B, which will become $95. In case party B wants to give securities as collateral, then margin is applied on the loan value. Logic behind applying margin is that party A needs to find someone who can buy those shares or securities, and it will not be that easy. And also party B has an impression that those securities are idle or have lesser value. That is why a margin is applied. Now assuming that margin is 10%, then the collateral value will become 110% of the loan amount, which will become $110 as security collateral, which party B will have to give to party A. To safeguard lender in case borrower defaults, cash or some other securities are given by borrowers to lenders at the beginning of the loan. These cash or securities are called collateral. As seen in the diagram, party A is lending security X and security Y to party B, while it is borrowing security Z from party B. Now collateral transfer between two parties can happen in two ways. One is bilateral and other one is triparty collateral. When both stock loan and collateral are managed by only two parties involved, in this case the collateral being exchanged is called a bilateral collateral. Lending and borrowing of securities keeps on happening during entire day, and end of day net collateral liability is calculated by both the parties, agreed, and then transferred to each other's account. Diagram of bilateral collateral was shown in previous slide. Now triparty collateral. When there is a third party which gets involved for exchange of collateral between the two parties dealing in stock loan, such collateral transfer is called triparty collateral. Party which manages the collateral in triparty collateral case is called a triparty agent. The triparty agent acts as an intermediary between those two parties and manages collateral for both of them. A separate triparty collateral account is created for both the parties. The triparty agent has access to both parties' local accounts and the triparty accounts at the depository. To understand why there was a need of third party getting involved in triparty collateral when bilateral collateral was already happening is because the triparty agent keeps on moving the stock as and when they receive the collateral calculation swifts. In this way, the risk of default from both the parties is reduced, and triparty agent is also specialized in managing the collaterals. If we look in the diagram, the step 1 is when lending and borrowing of shares happen between party A and party B. Once the lending and borrowing has happened, then the collateral calculation swifts are sent to triparty agent, who then, as per the swift messages received, transfers the shares from parties' local accounts into the triparty accounts and vice versa. Once that movement has happened, triparty agent sends back a collateral settlement confirmation via swift message to both the parties. Now what is mark to market? Since stock loan business involves securities and security prices keeps on changing, mark to market is a term where open stock loan and collateral positions are marked daily with the current market price. Usually end of day prices are used from yesterday to mark the price of securities on loan or on collateral. When two parties agree to enter into security lending, they agree on many terms. One of the terms of that is the threshold amount of collateral. Since securities values keep on changing, they can't keep on exchanging collateral as and when the security price is changing. So they agree upon a threshold amount above or below which, if the collateral is going, then they exchange the collateral. Usually mark to market is done every day, or depending on agreement can be done weekly. In case the change in collateral value is above or below the agreed threshold amount between the two parties, Party whoever has new pending collateral will transfer securities or cash equivalent to the difference occurred due to MTM as collateral to other party. As in below example, Party A has stock loan of value $100,000 on security X, where quantity is 1000 shares and price is $100, for which collateral of value $105,000 has been given of security Y, where quantity is 2000 and price of security Y is $52.5. 5% of margin is applied on collateral calculation. That is how we arrive at $105,000. Now when MTM is done next day, let's assume if security X new price is $102 and security Y's new price is $50, then the new collateral required will be 105% of quantity of X multiplied by new price of X, which will be 105% of 1000 shares of X multiply 102, which becomes $107,100. Now already provided collateral's new value will be quantity of Y multiply new price of Y, which will be 2000 multiply 50, which will become $100,000. So the change in collateral will be new collateral required minus already given collateral, which will become $7,100. So party A's liability has already increased by $7,100 due to MTM. Now assumed if agreed collateral threshold is $5,000, then party A has to provide more collateral to party B. In case security Y is again used as collateral, then 7,100 divided by current market price of security Y is equal to 142 shares of security Y party A will be sending to party B. In case a stock is out on loan to some party and there is corporate action, then the borrower will actually receive the impact of corporate action because borrower is currently the owner of the securities. However, lender being the original owner should receive back from borrower any corporate action impact that happened when the shares were out on loan. Since corporate action will involve changes in system values and multiple parties to get involved to get the impact back to the original owner of the shares on that corporate action, usually trading desks close down the position on stock loan for any approaching corporate action stock. For example, if party A has lent 1000 shares of security X to party B and there is a stock split 2:1 of security X, which means that party A has now lent 2000 shares of security X to party B, and party B while returning has to return back 2000 shares to party A. For this to happen, system entries needs to be changed and updated to show that the original loan has now changed from 1000 shares to 2000 shares. That is how a normal stock split corporate action will impact the systems and the lending and borrowing activity. We have come to the end of this video. So if you like our video, don't forget to share. You can also subscribe our YouTube channel, which is Capital Markets Easy, or you can drop us your queries on our email, that is capitalmarketseasy@gmail.com. No spaces please. Hope you like these videos. Keep on sending back your queries. Thank you.